We're very fortunate today to have two individuals to help us understand the most common question in any ESOP or co-op transaction is, what's my business worth? Mom and dad had it for years. I've had it for whatever. It must be worth millions, but it's never been formally valued and no one really knows. And that can really create some challenges as we move forward. So we have two speakers today that's going to help us understand how do we do this and what does it really mean. And Brad Miner started with Blue in '89 with a degree in business and accounting major from the Indiana University. Brad began performing business valuations in 1990. He's a certified valuation analyst and an accredited senior appraiser, a business valuation member of the American Society of Appraisers. Additionally, he's a CPA and has earned his AICPA specialty designation for business valuators and forensic accountants. He's also a certified machinery and equipment appraiser, member of the National Equipment and Business Brokers Association. Brad was elected to director in '08 and has overseen the firm's valuation and financial forensics group since '99. He performs business valuations, assists with real estate and machinery equipment appraisals, and has supported attorneys and clients in various areas of litigation. We also have joining us Shawwn Storms, who's a '91 graduate of Indiana University in Bloomington, where he majored in accounting. He received a CPA license in '95. Shawwn holds memberships in the American Institute of Certified Public Accountants, Indiana CPA Society, and the Institute of Internal Auditors. Shawnn's introduction to ESOPs came in 2014 when he began working with Tom Potts as an advisor and support role. Since then, he's been involved with numerous ESOP transactions and ongoing ESOP engagements. He's assisted with design, implementation, and monitoring of ESOP transactions and ongoing trustee services. And with that, over to you guys.
Well, good morning, everybody. I am Brad Miner, and I'm coming at you live from Evansville, Indiana, or as a lot of people call it, Heavensville, because we're so heavenly down here in about as far southwest Indiana as you can possibly get. It's always sunny here, never rains. Occasionally we get liquid sunshine, but other than that, it's pretty nice down here. So I'm actually the director in charge of business valuations for Blue & Company, which is a regional CPA firm. And we have offices throughout Indiana, Kentucky, and Ohio. I've been with Blue for 33 years, which means a couple of things. I'm getting old, number one. And two, I do have quite a bit of experience valuing businesses. So hopefully I can relay some of that knowledge to you guys today. And with that, I'm going to turn it over to former outstanding Blue & Co. employee, Shawwn Storms.
Thanks, Brad. Again, my name's Shawwn Storms, and as the introduction,
I don't really have to listen to it as long as it looks like I'm on. They'll send me the clarification.
Introduction bio that was previously provided kind of gives you a little bit of my background. I am a CPA and a partner in a CPA firm, but also do trustee.
I don't know how much money y'all
And
get
so
separate from the business.
Is everyone else here in that background?
Yes, sorry.
Yes.
Somebody needs to put themselves on mute.
Yeah, if you're not participating in the conference, I think
it's UUJ858 needs.
Thank you.
Okay, thanks. That's better. So I wanted to get started here, and I think what Brad and I wanted to try to do was just talk about a few things related to the ESOP and basics, and then specifically some valuation items that we think may help you as you think about maybe your businesses or your ESOP opportunity. But the first thing we wanted to talk about was kind of what is an ESOP? And, an ESOP stands for an employee stock ownership plan. That's what ESOP stands for. An ESOP is a qualified retirement plan, similar to a 401k plan. ESOPs are governed by ERISA, and rules are enforced by the Department of Labor. An ESOP invests primarily in employer stock, and ESOPs have specific rules to who may participate, vesting, and when distributions may occur. And an ESOP has a trust which owns the stock, and a trustee, someone like myself and others out there, who oversee the plan's activities. Additionally, ESOPs are recognized by the IRS as retirement plans, and other retirement plans are pension plans and 401k plans, which people are obviously used to seeing in their businesses. An ESOP is designed to accumulate value for the participants and to distribute this value to participants during retirement. So these are really set up to be long-term wealth creation retirement plan vehicles. That's really what they're set up for, is to help individuals create long-term value. And unlike other retirement plans with ESOPs, employee participants are not required or allowed to invest their own funds. That's one difference, is that, with an ESOP, our participants aren't contributing their own dollars. This is built up with company dollars over the years and value. And in ESOP, participants have a beneficial interest in the ESOP trust. The ESOP trust and trustee owns and votes the stock. I think that's one thing that's always interesting. Once companies form an ESOP, the participants think that they own stock or have stock, and wonder sometimes where their stock certificates are at. And we typically share with them that they own a beneficial interest, which is kind of an important item to them at the initial onset of an ESOP. Some interesting ESOP statistics. There are approximately 11,500 ESOPs in the US. This number is changing and in fact growing now, covering about 10 million employees. Some ESOP-owned companies have other retirement plans, such as 401k plans. Total assets owned by US ESOPs is nearly $1 trillion. There are about 333 ESOPs in the public sector, and documented studies indicate that ESOP-owned companies perform better than non-ESOP-owned companies over long periods of time. In terms of some specifics that we're going to try to cover in kind of a broad overview, we want to talk about participation investing and contributions, valuation. Brad's going to spend some time on valuation, allocation, what statements are needed each year, how distributions work, compliance, voting ESOP shares, corporate governance, trusteeship, and why ESOPs are significant to participants. So the first thing we'll talk about is participation investing, and this is in general. Who may participate in an ESOP? All staff employees who complete certain hour requirements in a calendar year are generally eligible. This is called the eligibility rule. And participation starts when those eligibility requirements have been met. Is participation mandatory? Yes, generally all eligible employees must participate. What is vesting? Vesting is the process whereby a participant obtains non-forfeitable ownership of his or her account, not unlike what you see in some other retirement plans. And once vested, your ESOP account balance is not forfeitable, and you will not lose your benefit even if you terminate employment. In terms of contributions to the ESOP plan are made 100% by the company. Again, the employees do not contribute cash or their own funds. These amounts generally are used to pay down the ESOP loan in the early years, which results in shares being allocated to participant accounts and the payment of benefits or distributions to retired and otherwise separated participants. It also helps pay plan expenses on an annual basis. Contributions can take the form of cash or company stock. In most cases, cash contributions are made in order to fund the repurchase obligation that exists after a certain amount of years. Employee participants may not make contributions to the plan. Again, people often wonder, can they make their own contributions with their own dollars? And again, they can't. And the IRS imposes limits on annual contributions to the retirement plans in general, ESOPs as well. In terms of valuation, since the ESOP's investment is in the company stock, it is necessary for the stock to be valued annually, periodically. There's no published market value for private company stock. And so therefore, each year the company's stock is valued by an independent valuation firm, which is what Brad will talk about here in a second. And this firm is skilled in valuing non-public companies. It's a specially niche service that various firms perform, and we as trustees go out and hire those firms to help us with that work. The value derived from the annual valuation is used for government reporting purposes and for participant statements. It's helped with the 5,500, as well as the participant statements that are sent out each year. As with larger public companies, stock values fluctuate from time to time, depending on company performance, industry trends, and economic conditions. So as the economy goes and your business goes and things happen in our world, so does the change in the value of the stock from year to year.
So I think Rick mentioned it earlier, that kind of a starting point, well, almost always a starting point in this process, whatever you're doing, succession planning, ESOP planning, cooperative planning, you need to know what the value of your business is. in the ESOP world, and by the way, what I'm going to talk about today is going to apply towards ESOPs, cooperatives, not-for-profits, regular companies. The valuation process is always going to be the same. The methodologies are always going to be the same. So what we talk about here is going to be applicable to everybody that's involved in the audience here. So again, the starting point's frequently the value. I'll just give you a couple of examples of how I'm hired in order to do the valuation. I've got one where the company hired me directly. And so we're kind of looking at the value of the business to determine whether an ESOP is even feasible or not. And so I'm kind of working through that process right now with them. Another way to do it, and Shawwn, I don't know if you've done it this way or not, but sometimes the company already has a pretty good idea of what their value is. And so the trustee can go ahead and hire the valuator directly, and he can do kind of a preliminary valuation to determine whether the process is going to go forward or not, because it can be an expensive process to go through all of this. And if the two parties aren't going to come to agreement down the road, you want to know that fairly early on in the process, so you don't spend a lot of money and then at the end of the day, nothing happens. So what do you guys need to look for in terms of, the value of who do you get to value the business? Well, first of all, you want to use a qualified appraiser, and we'll talk about that here in a second. You want to make sure that appraiser is following the right standards and guidelines, and what standard are you going to use? I think Chris mentioned kind of some different standards earlier, and we'll talk about those a little bit more in detail. And then whether discounts should be considered or not. How has COVID changed these, or has this, I think we're in a different world now. I don't think we're ever going to go back to pre-COVID world. I actually I had my second COVID booster yesterday along with the flu shot. So if I pass out halfway through this performance, you'll know why. So what are some of the business qualifications? So there's several organizations that, and you heard my credentials at the beginning. Sorry about that. I know I've got a lot. These organizations all sponsor in some way or shape programs that qualify people as business valuators. So the American Institute of Certified Public Accountants has their designation, which is accredited business valuator. Then the NACVA has a designation called Certified Valuation Analyst. The Institute of Business Appraisers has actually been incorporated into the NACVA now, but there are still some valuators out there with the CVA designation. And then the American Society of Appraisers also is a multidiscipline. So they look at not just business valuators, but real estate appraisers and machinery and equipment appraisers, jewelry appraisers, et cetera. So down here at the bottom, make sure you know who you're hiring, make sure that they do have some credentials that make them qualified to value your business. So what standards do we actually look at whenever we're going to value a business? Well, one of the most recognized is what's called Revenue Ruling 5960. And if you know anything about taxes and revenue rulings, the 59 means that it was written in 1959. And believe it or not, the IRS actually did something really good. This standard, it's pretty lengthy, but they basically walked through how you value a business. You'll see it still referred to frequently in business valuation reports today, even though it was written back in 1959. And it's kind of our base guideline. Certainly since then, we've improved and gotten a whole lot better. But I've got to give the IRS credit that they actually did a pretty good job that go around. Then the AICPA has what's called the standard of for valuation services. And I was actually on the committee that helped, we actually approved those standards, and in the process, we kind of helped write them. And then kind of the grandfather, or the one that's recognized basically worldwide is USPAP, and that's the Uniform Standards for Professional Appraisal Practice. That covers also multidisciplines. So it's real estate, machinery and equipment, personal property, business valuations, and some other little areas in there. But that standard is recognized by the IRS, the DOL, numerous organizations. So that's kind of, if your business valuator does not follow USPAP, he's doing something wrong, more than likely. All right, so what is the standard of value we actually use for ESOPs or cooperatives, we're probably going to be using the standard of fair market value. And you can see here, this was written, Revenue Ruling 5960, the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the relevant facts. And then the International Glossary of Business Valuation Terms came into play a few years ago. It's about the same definition. They just improved it a little bit by saying this is a hypothetical willing and able buyer and a hypothetical willing and able seller, and they're acting at arm's length. So the goal of fair market value is you've got a whole bunch of buyers and sellers. If you brought them all together in one big room and they were kind of bidding and trying to get this company, it's that number right down the middle is fair market value. Some people are willing to pay higher, some people willing to pay less, but fair market value is kind of that number right down the middle. And the reason that some people might be paying or willing to pay higher, and I think it was Chris that mentioned it earlier, is this different standard of value. And this is what's called investment value, or I think Chris mentioned it and called it strategic value. And that's what it is. It's a value to a particular buyer or seller. And so it might be a situation where your company is valuable to a much larger company because you've got some technology that they don't have. And if they get it, they can incorporate it into their stuff and take the value of your business and really expand it. And because of that, they're willing to pay a higher price. Or maybe they just want to eliminate the competition. Maybe it's one of your competitors and they're willing to pay a little bit more than fair market value in order to get you out of the market. That's a situation that you need to consider if you're looking to sell your business, for example. You might want to consider that option, and you might want to consider an ESOP option and see how the two work. Even though you're paying or you're getting maybe more from a strategic value, there's a lot of tax advantages to an ESOP that might make those differences a little bit closer. So those are kind of the two different standards of value that we look at. So again, fair market value is just kind of an arm's length transaction. Investment value is more of a value to a specific investor. All right, let's actually talk about how to value a company. So with any small, closely held company, and small, closely held is not well defined. I've valued companies as small as $100,000 in revenues all the way up to, we've got a client that is always getting really close to the 1 billion mark. They hover around 950 million and they always want to get over that billion mark, and then COVID hit and knocked them back down a little bit. So they're still trying to get back up to that. But basically any privately held company, we're going to use these three approaches. So we've got an asset approach, an income approach, and a market approach. The asset approach looks at your balance sheet and says, hey, I've got these assets. If I sold all of them, paid off all of my liabilities, whatever's left, that's the value of my company. It's really not frequently used in the ESOP world. It is occasionally. We'll talk about it a little bit more. The income approach looks at the cash flows or income that the company is generating. And it says, hey, this company is generating X dollars in cash. What would I, as an investor, be willing to pay in order to get the rights to those cash flows? That's an income approach. And then a market approach says, hey, there's transactions going on out in the world. For my type of company, what are the multiples? And you'll hear that a lot. What's the multiple for my company? And that's a market approach. And so we'll dig into each of these a little bit more. So an asset approach, again, is a general way of determining a value indication of a business using one or more of the methods based on the value of the assets, net of the liabilities. And so again, we kind of look at the balance sheet and say, do we need to adjust any of these items? We're not going to spend a lot of time on this method because, again, for ESOP purposes, you probably don't want this. A lot of times I call it a better off dead methodology, because if you sell all your assets, pay off all your liabilities, the company's not in business anymore. That's not always exactly the case, but in general, that's kind of the way it is. But we would go to the balance sheet, and if the company holds real estate, for example, we would take that real estate and adjust it to whatever its current market value is instead of its book value. Same thing with equipment. We might look at inventory and say, is it good inventory or not? Are we holding on to a lot of old inventory, and we might adjust those? And then the other thing we look at is, are there any assets or liabilities that are truly owned by the business that aren't necessarily on the books? And so we pull those into our business valuation. A lot of times those type of assets would be intangible assets, and we're gonna get to the value of those under our other two approaches. So let's dive into the income approach, this is a pretend approach that we use probably at least 85% of the time. Shawwn, I don't know what's your experience in seeing business valuations.
I think that's pretty fair to say. Most of the time, that's the method we see, and quite honestly, the method we prefer usually in terms of the companies we work with.
So the income approach, we actually look at kind of two different methodologies: capitalization of benefits method and discounted future benefits method. The difference between the two is the capitalization of benefits method kind of looks at the company's history. And based on that history, we're still predicting the future, but we think that the company's probably not going to be much different than it has been in the past. So we look at the company's historical cash flows, and we come up with a good rate of return, or what would I as an investor want to get out of this business. And the combination of those two is going to give me a value kind of based on the company's historical cash flows. The discounted future benefits method, on the other hand, we're actually trying to predict the future. And this might be the case whenever we've got a company that we know we just landed a big contract that for the next 5 years, we're going to make twice as much money as we used to make. And so instead of looking at the historical earnings, we want to project out what we think that's actually going to be, present value those cash flows back to today, and that's going to be the value of our business. So that's the difference between those two methodologies. They're both based on basically how much cash can I put in my pocket, right? And that's why Shawwn said that that's kind of the preferred method, especially in the ESOP world, is because that's what we're concerned with. That's what he's concerned with as trustee is, hey, is this thing going to be able to pay for itself or not? How will it be able to pay for itself? Well, it's able to pay for itself out of its cash flows. And so either one of these methodologies I've used in the past on ESOPs, we do use the discounted future benefits method quite a bit because we're really trying to predict the future as best we can, taking into account good things or bad things. So that's those two methodologies. How do we get to our cash flow stream? So some of the streams you kind of look at are net income before tax, net income after tax, EBITDA. You hear those terms a lot. It's not even on here, but the one that we use almost all of the time is a true cash flow. Again, how much cash can I stick in my pocket? And how do I get to that point? Do I just go to the company's tax return or financial statements and automatically take the bottom line and say that's what the answer is? Probably not. We almost always make some type of adjustments to that cash flow. Some of the common adjustments that we'll make is officer's compensation expense. So maybe, for example, an officer's been paying himself, the one I was working on yesterday, he was paying himself $60,000 a year. And the company was about a $10 million revenue company. And so we said, realistically, to bring somebody in and pay them to do what he has to do would cost about $300,000. And so we actually made a negative adjustment to cash flows in that case to get to a proper cash flow number for the company. Some of the other things we look at commonly is rent. A lot of times the company doesn't own the real estate, but the owners do. And so we got to make sure that rent that is being paid to the outside real estate entity is the correct amount. So we might make a market value adjustment for the rent expense. And then a very common thing we do is non-operating or non-recurring adjustments. So for example, if we had a lawsuit and we had to pay guys like Fenton $500,000 in order to get that lawsuit settled, whereas their normal legal expense is only $50,000. Well, we'd make an adjustment of $450,000 in order to get to the proper cash flow going forward. So those are some of the common cash flow adjustments we would make. something that we look at very closely on every valuation we've done for the past, 2.5 years now, I guess. Now 2 years, I guess, is PPP loans. It's unusual income. The government just gave us money, right? And then they forgave the debt. And so that's kind of unusual income when you just hear it that way or think about it that way. But what we really look at in all of the companies that we value was that really just extra income? Sometimes it was. Sometimes the company just kept going along. COVID did not affect it at all. So they just kept going along smooth. And so that really was just kind of extra money in their pocket as security. Other companies, COVID really hit them and they had to send people home. They had to do extra things to get people to be able to work. They had a lot of additional expenses. And so sometimes we just offset that forgiven income with expenses that were incurred. And so maybe the two offset. And sometimes maybe those expenses were even more. So it's not enough to do that. We might even have to make an adjustment the other way to get the company back to normalized earnings. So that's the income approach. And the last approach that we look at is what's called the market approach. I've got 3 different methodologies here. So we've got guideline public company method. That's where we look at actual public companies, IBM or Eli Lilly, and they have a price earnings multiple or a price cash flow multiple. And if our company is truly comparable to one of those companies, we can take those multiples and apply it towards our private company and say, hey, if it were publicly held, this is probably about what it'd be trading at, and here's what the value would be. That's a guideline public company method. The guideline transaction method, we have several databases at Blue & Company. We've got 4 or 5 different databases that have actual transactions of small, closely held businesses. So businesses just like you guys own, that it's actual transactions out in the real world. People are doing this arm's length negotiation, which is what fair market value asks for. So they're doing these actual negotiations. We take that database and come up with multiples. And again, it might be a price cash flow or a price revenue multiple. And we take that multiple and apply it towards the company's information to come up with a value that way. That's a guideline transaction method. I saw a question in chat earlier asking if there was like a rule of thumb. And I think that may have been a question for Chris, but somebody had asked, is there some type of rule of thumb to come up with a value for the business? And that's what we call an industry method. And there are rule of thumb methods out there. I've never relied on one exclusively, but we do look at them because they might give us an idea of what this industry thinks the value should be. Just one example I had is propane gas company that we valued many years ago. And at the time, it was how many gallons of propane gas that were being sold. And they valued it just based on the gallons, not necessarily on what the company made. And that was probably because it was more of a synergistic value. That's why we don't rely on the industry method. And then just one quick funny story. A partner of mine, Cam McQuay, Shawwn, I don't know if you remember Cam, but he and I had valued a physician practice, and we're sitting down in a meeting and going through all of our charts and our cash flows and everything. And the doctor kind of interrupts us and he says, what multiple am I getting? We said, well, what do you mean by multiple? And he said, I don't know. I just know that Dr. So-and-so down the street got an 8 multiple, and I want to make sure I get an 8 multiple. He didn't even know what the multiple was applied to. So we said, sure, you're getting an 8 multiple. So you got to be careful with the industry method. Price is what you pay, value is what you get. I think Warren probably pays a lot less than the value he gets for the most part. So let's talk about discounts a little bit and how these might apply in the ESOP or even a cooperative world. Is two that we're going to look at really are on the top here. The discount for lack of control. It's also known as a minority interest discount, or the discount for lack of marketability. And what the discount for lack of control says is if I own less than 50% of the voting stock, I don't have the ability to set dividends, to pay salaries, to sell assets, to buy assets, to sell the company. I lack a lot of controlling attributes that would be nice to have. And because of that, if I were an investor, I would lower the price of the stock that I'm going to pay in order to take into account some of those lack of control issues. The lack of marketability, on the other hand, says, unlike IBM stock, which I can turn into cash in 3 days, my small, closely held company is probably going to take a little while to sell it, and there's probably going to be some cost involved in it. And so I can't just take it and immediately turn it into cash. And because of that, we're going to use a lack of marketability. So this chart, it's actually, you can see it a little bit better than I expected. But whenever we do a valuation, we kind of come to a value that's at the very top. And then we consider these things that I just talked about, our lack of control. How much does that affect the value that I'm willing to pay for a share of stock in this business? And that might be 15, 20%, 25%, somewhere in that range. And then at the next level, I look at the marketability and how marketable is this company? Maybe it's in an industry that is really active and they could sell it pretty quickly. So my marketability discount may be very low. Then again, it may be in an industry that's really stagnant and that marketability discount might be a lot higher. There's no black and white answer to that. In the ESOP world, I think you typically see there are evaluators out there that say that there should be no marketability discount in some situations, up to, maybe as high as 15 or, on an outside edge, maybe 20%. So you've got kind of a range of discounts there whenever we're talking about this.
Hey, Brad.
We'll skip. Yeah, go ahead.
Hey, we have one question from a participant.
Sure. Yep.
And the question goes as this: on an income evaluation approach, what is the standard length of years projected to get the value to the valuation? Is it tied to how long the buyer or investor is expected to see their full return?
There is no standard length. I think Fenton said earlier, typically 5 years, and that's absolutely the case. A lot of times, though, I've seen businesses that you can really only remotely predict a year or two. And so we've used projections as short as 2 years. I've been in situations where we wanted to run out, something, whether it was a loan or an asset purchase, where we've gone ahead and carried it out 15 or 20 years. The typical is, I think what Fenton said earlier, is 5 years is typically what you see.
Mm-hmm. Thank you.
And I'm going to skip ahead here real quick so just this second line down, it's ESOP basics, 30%, 51%, and 100%. The reason that in an ESOP world, you'll see these percentages is the 30%, if you do at least 30%, there are some significant tax savings if you do at least 30% sale of your company to an ESOP. And so at the 30% level, however, if we go back to this slide, we're going to have to take both a minority interest discount and a marketability discount more than likely. And so the value realized by the selling owner to the ESOP is probably going to be relatively significantly less than it would be if he sold 51 or 100%. So at 51%, the ESOP now theoretically is in control, and there's rules and questions and things about that. But at 51%, you're at least in control. And so therefore, we would probably eliminate the lack of control discount. We still might have a marketability discount because, especially at 51%, you still got 49% shareholder that we always call a nuisance factor. And so that might still mean that we need to take a marketability discount. And even at 100%, a discount might be very low, but there could be some marketability issues. So you might be at a 5% marketability discount. Rick, if there's no other questions, I'm going to pass it back to Shawwn.
Yeah, the only one comment that I have is that oftentimes, you'll have an 8A certified company, whether it's minority or woman-owned business, and in order to maintain that certification under an ESOP, it may limit them to be a minority-owned ESOP where it's 49% is owned by the ESOP share. So that's one driver where it would preclude you from going to 100%.
Right. And so, Rick, what you're talking about there is different than the minority shareholder in the discount section. You're
Right.
talking about a true minority that owns a business, and they have to maintain control. So they have to have 51% in order to maintain that minority or woman-owned business status.
Correct. Yep, and there's no more questions in the chat.
Okay, Shawwn, back to you.
Okay, thanks, Brad. Nice job on that section. So kind of back to the agenda, the next thing we wanted to try to cover was just, for example, allocation. So, how are contributions on an annual basis allocated among participants? Well, each participant receives an allocation based on his or her qualified wages as a ratio to all participants' qualified wages. So it's pretty easy math when it's all said and done in terms of the allocation each year. Should be when the third-party administrator does that calculation. And the allocation calculations are performed, as I just mentioned, by a third-party administrator after the annual valuation is complete and the price is set for the stock. And these calculations are reviewed and approved by management on an annual basis. So once we're done working with the valuation firm, those such as Brad and his peers, then we meet with management, the board, to talk about that price so they understand what's going to be for their feedback as well. The next area would be just the statements. So each year, ERISA requires ESOP to issue participant statements to the participants. And we like to make sure that's done. The third-party administrator generally helps with that. And again, it's after the allocations have been done and the stock has been valued. Those statements are prepared and mailed or delivered to participants. Oftentimes, we see those being delivered at an annual meeting where the participants join and go through a number of company things. These statements will reflect allocated cash, if there is any, the shares owned by that participant, the value of the shares, and the vesting percentage, as well as any other pertinent information. In terms of distributions from an ESOP, once a participant employee leaves the company, the process for determining distributions and timing begins. This process includes notifying all the appropriate parties of a separation of service, which would include the company, the HR group, the participant, the TPA. There are various rules that govern plan distributions, and these rules cover when payments begin and how they are calculated, et cetera. And so it's really important to understand that, because we see from time to time when things happen. So for example, there may be a tragedy, and oftentimes the timing on when those distributions occur are a lot longer than any of us would like, but it's governed by the way the plan document reads. And again, these rules are specific to the ESOP, as one I just mentioned, but you should always refer to the summary plan description. Okay. In terms of compliance, as with any qualified retirement plan, there are specific requirements for compliance with the IRS and the DOL. And these rules and regulations we adhere to. And again, these are highly regulated retirement vehicles that have a lot of complex rules, both with the DOL and the IRS. And we obviously are paying particular attention to those, as well as new rules and regulations that come out. Your ESOP team, the benefits committee, the trustee, the third-party administrator, we do work hard on an ongoing basis to make sure that we are in compliance and doing things as we should be. In terms of voting ESOP shares, the trustee votes those shares with a single focus on the best interest of the ESOP and the participants. That's really our primary responsibility, to do what's in the best interest of the ESOP and the participants. One exception, and there are a few other, but one primary exception is a pass-through voting, which happens on a substantially sale of all the assets of the company. We have had that happen a couple times, and those are pass-through votes to each participant. And again, a reminder, the trust owns the shares and participants have what's called a beneficial interest, which I covered earlier. In terms of corporate governance, I think one thing that's kind of confusing to participants is what happens after the ESOP's formed and we're an ESOP, and how do we do our everyday jobs, or how is the company governed? Well, the board of directors continues to make and approve all major decisions, such as significant capital expenditures, compensation, acquisition, joint ventures. All those types of strategic and tactical day-to-day decisions are governed by the board of directors, as they were prior to being an ESOP. Executive management continues to make and approve their decisions, effectively running the company as they did pre-ESOP. And we try to basically follow the policy that, hey, if it's not broken, then we're not going to try to fix it. So what you were doing well before you became an ESOP, we want you to continue even better after you're an ESOP. In terms of the trusteeship, we serve as the trustee, and a trustee is an independent of the company, other shareholders and executives. The trustee again votes the shares. The trustee approves the slate for the board of directors and monitors the board's activities and decision making. So we serve somewhat like a quarterback with the board. We determine the annual value of the company stock, as we've mentioned, based on the help of the valuation firm. We oversee all ESOP plan activities. We review company financial performance on a regular basis. One of the things that we do is we're receiving financial information and commentary, typically quarterly, from our clients to understand how the year is going and or if there are any issues. And it also helps when we get into working with the valuation firm on setting the price of the shares each year. And we also consult on a continuous basis with the related ESOP committees, i.e. the benefits committee, the communications committee, and the administrative committee. In terms of the significance of ESOP to participants, again, ESOP is a qualified retirement plan with primary focus on providing retirement benefits to participants and long-term wealth creation. As the company goes, so goes the ESOP, and participants benefit from the growth of the company value and contribute to the same growth by their own efforts. And that's, I think, a key thing is once they're a beneficial owner, the efforts they make on a day-to-day basis not only provide them with a paycheck, but also provide them with something over many, many years of dedicated service to the company. And that is all we have. We want to thank you for attending. I think we want to allow a little bit of time, maybe 10 minutes. I believe lunch is next for everyone, but we wanted to allow everybody a few minutes if they had any questions.
Hey, Shawwn, I think it was Aristotle who said, he who speaks before lunch better keep it short. So I think
That's
we're in
right.
good shape.
That's right.
But Rick, if there's any questions.
Well, one question, I know you talked about the discounted cash flow. Typically, when you guys do evaluation, either for an ESOP or co-op, are you using one method or are you using multiple methods and kind of, best guess blending them together? Because I think that the valuation piece, it's certainly part science because it's just math, but there's sort of an art to it as well.
Absolutely. There's a lot of it is an art. There is the scientific piece of it, and we're trying to make that even more of it. But at the end of the day, there's a lot of subjectivity on my part that I have to bring to the table. I've done it both ways. Typically, we're going to rely on one methodology, but there's situations where we've said, you know what, we're not exactly sure. I've got one company right now that we do the annual valuation, and they kind of have a good year, and then we look like they're on the right trajectory, and then they have a really bad year. And so we actually do a blend of the adjusted book value method, which is that method I said we don't use a lot in the ESOP world, but it's kind of a base board, and so we give it some weight. And then at the same time, we say, hey, this company has no indication that they're going to stop operating, so we'll give the cash flow approach a little bit of weight.
Okay, thanks. And I guess another question would be that, as the company, from the board's perspective, the trustee hires the valuation company, they do the valuation, it gets approved, it gets transmitted to the board. What's the board's oversight role in terms of monitoring, kind of the trustee and the valuation company's performance?
I'll let Shawwn take that one.
What was that again? What was the question again?
Oh, hey, Shawwn. So the question is that, the trustee hires the valuation company, the trustee reviews and approves the valuation and then communicates it to the company. What's the board's response, or what's the board's responsibility in terms of monitoring the performance of the trustee from like a due diligence perspective?
Yeah, I think, we have varying responses to that from the boards, but typically I think the board's responsibility is to understand, one, are we using, competent professional valuation firms to help us do our work? Are we involved in the due diligence meeting? Are we involved in their company? Are we following the rules of what we've, or what we've set out in terms of our engagement letters to be a fiduciary and handle that responsibility? We have some of them that go through a formal evaluation process each year, and then we have a lot of them that are very informal in terms of that. But I think typically when we take over for trustees, and serve as a successor trustee, it's typically been the result of the board has terminated that relationship. And it's kind of a circular reference, really. The board has terminated that relationship just because the trustee's not been that involved in the kind of the ongoing understanding, the ongoing activities of the business, and really not, doing the minimal amount of work that they could possibly do. So we try to stay very involved in our clients to understand, because we think that's part of our responsibility on behalf of the participants.
Okay, and we have a question from the group as well. Let me see if I can grab this here. Is there a difference in the level of difficulty in valuing a business converting to an ESOP versus as a worker co-op? And then what's the cost of the valuation? Is there a range?
That's not fair. It depends on the cost. The difficulty, I don't think ESOPs do have a couple little extra features that sometimes you need to take into account. They might have warrants or SARs, stock appreciation rights, or something like that you might not have in a cooperative. So there might be a little bit more difficulty involved in an ESOP, but I've done both.
Okay, and another question is, understanding that in valuations, you must rely on the information, including projections that company management provides, and that you will obtain representations from the company regarding the provided information. But can you comment about the course of action you might take if the projections appear unreliable, or maybe the projections, they're the hockey stick thing, they don't match prior performance?
Sure. We've had to go back to owners or management and say, there's two options. One, we can hit you with maybe a bigger discount or a higher, I talked about a rate of return is what's needed in order to value the company based on its cash flows. Maybe that rate of return is significantly higher because of the risk involved in relying on those projections. But yeah, I'll give you a good example. I just did a company that they were 3 months into it, so they kind of knew that their projections were optimistic. And we talked to them about that, and they said, let's go back and revisit it and redo those projections. And they did, and we were able to reach an agreement that way. So we challenge those projections pretty heavily. We have to. There's it's called the Great Bank Settlement out there that discusses the fact that us as business valuators have to test those projections very closely. And so what we do on kind of long-term clients is we look at their history of projecting, and we say, how did they do in the past? And if they're pretty much in line, then we rely on those projections pretty heavily. If they're not hitting those projections in any way, year after year after year, we're probably not going to rely on those projections too much.
Okay.
I think that's right too. We look, I think, in the diligence stage of both on transactions and in ongoing work. What Brad just mentioned in terms of that look back is really, really important. The other side of that is we have some clients that are way too conservative on their projections. And that can be a bad thing as well, because keep in mind, participants are being paid out based on the value of that stock. And if it's low based on really, really conservative projections, that's not fair either. So, typically we think of these hockey sticks that we discount back some way or really, really challenge the management team. But we also see it the other way, where they're just being way too conservative over periods of years, which we have to address as well.
I agree with that, Shawwn. We almost see the more conservative almost more often than we see the aggressive.
Any other questions from the group, please? I don't see anything else in the chat. I'd like to thank, Shawwn and Brad for your guys' participation today in helping to, demystify that what's my company worth. It's always, sometimes it's a sticker shock to the owner of the company with respect to, gosh, it should be worth a lot more than this. And in some cases, the alternates in case it's like, wow, it's worth that much. That's awesome. And managing those expectations is really critical from a transition either to an ESOP or a co-op, because if there's a huge mismatch, then probably the deal's not going to go through.
Yeah, Rick, I have to run into that a lot. I do valuations not just for ESOP purposes, but for succession planning purposes. And a lot of times the owner's like, this is all it's worth after 30 years of really hard effort. And I have to explain to them that, well, you've taken a whole lot of that value out in the form of salary and distributions, and you've taken a whole lot of that value out over the 30 years. And as it sits here today, yeah, that's what it's worth. So
Awesome. Well, with that, we'll close this session down, and the next thing is lunch, and then we'll reconvene at 12:30, Deb?
That's correct.
Okay, we'll see everyone back at 12:30 to talk about governance, and it'll be an exciting discussion.
Thank you all.
Thanks.